Welcome back to the Smart Investor Show, where we break down the strategies and stories behind smart property decisions. Today's guest is Dion Fernandes, mortgage broker, finance specialist, and host of the Finance This, Property That podcast. Dion is part of the award-winning team at Emerge Finance and has helped over 200 investors strategically scale their portfolios. What sets Dion apart is his deep understanding of how finance fits into the bigger wealth-building picture. Whether you're a busy professional, a self-employed business owner, or an investor looking to grow, Dion's strategic approach to structuring debt, boosting borrowing power, and protecting cash flow makes finance work for you, not against you. He's here to break down what smart finance strategy really looks like in today's market. Dion Fernandes, welcome to the Smart Investor Show.
Thanks, Julian. Appreciate you having me on. One podcaster to another. Converted you.
You have. You were good inspiration, and it was enjoyable to be on your podcast. So I thought I'd better get myself started. So I appreciate your time today, and it'd be good to, return serve. And this time, me asking you lots of questions and digging into your insights and a lot of your knowledge and expertise, particularly around the topic of finance.
Appreciate you. Like I said, appreciate you having me on. It's a little bit weird being on the other side of the camera or the microphone. But one of my goals this year is to appear on 5 podcasts. So this is one of 5.
I'm glad I'm your number one tick.
Actually, you are my number one.
There we go. Well, mate, as we normally like to do traditionally on this podcast, apart from digging into your knowledge, is I'd love to learn a little bit more about the Dion Fernandes story. Maybe taking us back to school days or migration, whatever it might be, and through school, and then obviously how we through career and how we landed where we are today.
Oh, yep. No worries. Can do. So like yourself, migrants, I was born in Mumbai, India, or Bombay, as it used to be known. We moved to New Zealand when I was probably 6, 7, so 1988, 89, around about that time. Mum and dad, pretty hard workers. Dad's a chef. Mum worked in high-level administration. I'm the eldest of 4, so I have 2 other brothers and a sister. We're all very diverse. We all ended up doing very different things. My youngest brother is an accountant. He's a CPA. My sister is actually a doctor/surgeon. The second oldest, Craig, he's a chippy. So he works in building houses, and I do finance. So it's a bit of an array.
Oh, you've got your own team there. It's fantastic.
Oh, I know. Yeah. Well, I've got someone to run the numbers, someone to resuscitate me when I almost die of a heart attack of the numbers, and then someone to fix my house if there's any issues.
I was going to say every family needs a tradie in the family. You're right.
Oh man, it's handy. He's actually moved to the Gold Coast, so he's picked up a job within a day of being here.
I was going to say be pretty busy in the Gold Coast right now. That's for sure.
Oh yeah, 100%. So yeah, look, we moved to New Zealand, grew up there, did all my schooling there. Didn't really know what I wanted to do. Like through those years, I also used to play quite a bit of tennis. Until an injury to my wrist pretty much stopped me, but I used to play a lot of sport. Ended up actually, probably something a lot of people don't know, is I was a professional tennis umpire.
Wow.
Yeah, so traveled the world umpiring tennis, did about 8 or 9 Australian Opens, on the lines and the chairs. I've done 2 US Opens in 06 and 07. Umpired the likes of Agassi, Sampras, Federer, all the big names you could think of. And yeah, just loved that life. Got to see a lot of the world. That was my first experience of conflict resolution.
So just is that a full-time, silly question, is that a full-time job?
Yeah, back then it definitely was.
Yeah, right.
Yeah. So in 06 and 07, that's when they started to release the line calling technology. So US Open was the first one to release that on a couple of courts. But now basically all your major tournaments on your major courts are all electronic line calling. So to make it a career is a little tougher. I was one of the few people that got a chance to umpire with the ATP. They only grant you 1 or 2 visas across the whole world. But yeah, and all I had to do was go to Sydney to get it stamped in. But then we had the GFC, and you pretty much, you weren't going to make a lot of money. It was going to, be a loss. Decided to settle down with my now ex-wife, bought a house. Then, yeah, just got into banking, basically. Got into banking.
They thought, damn, I'm going to get a real job.
Yeah. I don't know. I just applied. It was at the very bottom level, so entry level. And I think they hired me because I had insurance experience because I used to work for Allianz as well. Yeah, it was a really great experience. Got to learn, use all my people skills and conflict resolution skills and work my way up to, done all the roles in retail banking, branch manager, customer service manager, lender, lending coach, things like that. But funnily enough, I never actually wanted to be a lender. I didn't see myself as lending money to people as a career. It was told to me in order to get a branch manager role, I had to know how to do lending. But then what that's actually taught me is basically how to run a business. Because when you're a branch manager, you've got all the different line items to manage and make sure they're performing. Then you got to manage staff, which, as you would know, as your business grows, you get staff, and you got to be able to manage them, but then also manage expectations of clients and give that level of customer service. So all that sort of has been a really big reflection once I started at my own business in mortgage broking with Emerge Finance. So I work for Emerge Finance and I subcontract through to them. So really good brand. But yeah, I've just grown like 15 years in finance, worked everywhere, been broking for 4 years now. And yeah, October 23 is when I took the leap to run my own show. It allowed me the opportunity to meet people like yourself in a past with a past company. Also just learn the ropes, understand, this is a different game and how I actually make a difference in people's lives. And before going out on my own, I'm very clear on my vision. My vision is to empower financial legacies for generations. And the whole reason behind that is my daughter. I'm now a single parent, mortgage, have my daughter 50% of the time. It's a juggling act. She's 12, turning 21. So I know I'm in for a rough ride. I'm sure that you're going, oh God, you're in for a rough ride.
Mate, I've got 2 daughters, so I'm with you, and I'm ahead of you. They're already teenagers.
Yeah. So look, there's no way I'd trade it for the world because, she sees what I'm doing as something for her as well. And so we're pretty open in the communication around that. I don't know whether she'll follow in my footsteps, but that's not a me decision to make. She's into the phones and fashion and makeup right now, so it doesn't really matter. So yeah, and here we are, 15 years later, running my own business, and it's growing. It's great.
Yeah, and it's a great story, and thanks for sharing that with us. And I think one of the things I see and talk to a lot of, business people or entrepreneurs who start their careers in that corporate environment, I think it's the discipline, obviously working for a big bank like you did, the discipline, the compliance, your HR police sniffing on the phone every minute of every day to get KPIs done and all the other things you need to do to manage all your teams. I mean, that's probably held you in good stead too, right? Just to have those structures, even though that's probably the best thing to get out of your life once you start your own business is all those structures, but a very good grounding, I believe, for entering into, into your own business.
Oh, 100%. There's a lot of value. There's a lot of things that I always say to people, you've got to keep learning and learn from mistakes, you learn from mistakes, but also learn from your wins. It's as important to learn from your wins as it is to learn from your mistakes, because you know what you did right. Maybe just do that more often, and vice versa for the mistakes you make, do that less, but refine how to not make that mistake and be able to teach it.
Yeah, no, it's a great background, and I think we're all lucky to have that grounding to enter into the business world. So, mate, this is one of the key topics here is around property investing, and be remiss of me not to ask you if you got a property investing story or journey that you could share with our listeners.
Yeah, no, definitely can share. I'm in a phase, obviously, going through separation, divorce, things like that. I've restarted, but I got to a stage where I paid my one of my big goals was to pay my home loan off before 40. And I managed to do that on the 23rd of December, the year before I turned 40. And my birthday's in January, so got that part, but basically had to restructure all that with the separation, etc. So starting again, but the one big thing I can hang my hat on is I paid that loan off in 7 years.
Right, so it can be done.
Well, look, I mean, I didn't spend money, and I think that was my biggest key takeout, was being frugal with your money, only spending on what you need, and you don't need to live like the Joneses. So that's the way I sort of looked at it. Utilized offset facilities, savings. If I ever got a bonus, I would just pop that away. Any tax refunds, pop that away. I also managed to put a little bit extra into super, which was great. Obviously, having two incomes and everything like that helps. It's just about how you manage money and what your views are on money. The flip side of that, what it allowed me to do is go purchase an investment property. And it was more of it's a lifestyle. We love going up the Sunshine Coast. So I purchased a unit, renovated unit for $460,000 in, let's say, 2019. It had blocked water views, but you could still see the water because they called it garden view because they had one palm tree in front of it, but you could still see the water. Beautifully renovated. Like, I could live up there. That was one of my things. It was in a holiday letting pool, so the expenses were quite high, but it still returned really well. And it served the purpose. So one of the key things I didn't realize there is back then, but I look now, is like the property needs to serve the purpose, whether that be, capital growth, high yield, or a tax minimization strategy. How do you go about doing that and making sure your accountant's across it? So I can now say that to people. That was very much a tax minimization for me, earning pretty good money working in the banks, tried to reduce a bit like that. So it's all about that structure, had a good team behind me. Again, through the separation, sold that property probably 2 years later. It went through COVID and still made a profit during COVID.
Wow. I mean, yeah, when you first start talking about it, I'm like, that's quite an emotional purchase that you've done there. We've all been on holidays. We want to live there. We want to buy something there. But it sounded like there was an emotional attachment to it, but there was also some good financial gain as well.
Oh, 100%. Yeah. And like I said, it was pretty good. It still made profit despite the expenses. And when you put all the extra bits in, it was probably more negatively geared because of the expenses, which is fine. That's part of the strategy anyway. But it survived COVID. It really did. And when I sold it, we bought it for $460, ended up selling it for $635,000. So made a nice little profit. Had to pay the capital gains on it, but that's just the cost of doing business. You still made money on it, but because we held it for more than 12 months, got the capital gains discount on there as well. So fast forward to where I am now. I've also done a couple of developments. I've been what we call a joint venture, so JV partner in a development. So I provided some money for that. So got into developments because I do fund a lot of clients' developments and things like that as well. So I know I can talk the talk. I've been doing all that, being a JV, being on the other side, so not being directly involved, but I organised help with finance and things like that. Got my money back after 12 months because it was all completed. Now, where I'm currently at, so I kept the property. Now I'm actually rent vesting.
Wonderful.
So I've rented my previous owner occupied property out. I'm now renting where I want to live, closer to the city, closer to work. It's not too far from my daughter's school. The old house is now being rented out. Gives me a bit of a second lot of income. It will look after itself. I don't really have to do that. The play is I'd rather have pay for all that with pre-tax, live where I want to live, because living here, I don't, owning this property would probably set me back, $8,700 a month based on the current values. I don't even pay half of that. So it makes sense. And it's a good lifestyle and a bit of a change. My daughter and it's been 4 years. So I've been in that property for 12 years. Plus that is I've got 6 years now to, if I want to sell it, because I lived in it, I hopefully, touch wood, if it's still around, I can make use of the capital gains exemption. So
that's right. No, well, that's great. Good journey. And there's always hiccups along the way, regardless of that life will throw. And good to see you rebuilding. And the rent vesting makes a lot of sense in the situation and the status you're in now, particularly in your own business. It's probably the biggest trend that we've seen. We've discussed that before, right? Probably the biggest trend we've seen in the last 12 months, 18 months is that rentvestor. They can't afford to live in New Farm if you're in Brisbane or Bondi in Sydney. And, queue if you're in Melbourne, for example, these sort of affluent areas. So they give up on that strategy and start investing in property and still living in the good areas that they want to live in to keep their lifestyle up, but are sensible enough to start investing in properties and then look at, buying that first family home maybe 5-10 years down the track.
Yeah. And again, I sort of preach it a little bit to my clients. How do you create wealth? Having a large owner occupied loan hinders your borrowing power because there's no income coming from it and there's no tax deductibility, but you're also paying a higher repayment back, technically a higher repayment, because you're paying it at circa current rates. You get 80% rate at 5.94, 5.89. So whereas if you're going and living where you want to live, the values are higher, but the rent's not apportioned to the current rate. Like I think my yield is probably in this place probably about 3%, 3.75-ish when I worked it out. So why would I pay a loan back at 5.89 but then pay 3.75%? It doesn't make...
No, logic doesn't equate, does it? Yeah.
No.
The Smart Property Show is proudly brought to you by Search Party Property, nominated by REB as Australia's best buyer's agency and buyer's agent for 2025. Looking for your dream family home, a prime commercial property, or a smart investment? We've got you covered. Unlike others, we don't rely on selling agents or property managers. We have boots on the ground in key investment cities across Australia. Powered by data-driven insights, we give you the edge to secure the best deals. Ready to invest smarter and grow faster? Contact Search Party Property today for a complimentary discovery call. Mate, that's great. And thanks for sharing and getting a little background insight into you. But I'd like to now pick your brain a little bit and, share some of your professional insights with our listeners. One of the things, we've talked about in the past is strategy. And, something I like about your business and you personally is that you're very much about building strategy with your clients rather than just finding them a loan. So can you tell me in your words, what is it that difference between just getting a loan and building a finance strategy? And what is the way, you guys go about doing that for clients?
Yeah, no, 100%. So the business I want to build is a business that supports like time poor industry professionals, right? So I deal with a lot of doctors, lawyers, developers, self-employed clients. I think I've worked out about 90% of my clients are self-employed. There's a lot that goes into doing an application and you want a strategy. Building a portfolio is all about having a strategy rather than getting the loan. To sum it up, the loan is a product. That's all it is. A finance strategy is a roadmap to success. So when I look at that, I look at, you got to look things like structuring strategically. Who owns it? What entity owns it? What loan splits? What repayment types are you doing? Are we going to do future equity releases? Are we building this new debt for tax effectiveness? So you're not thinking of just this right here. I'm questioning my clients as to, okay, what are your next 3 steps? And then working backwards from there. So my motto is go slow to go fast. The team hates me for saying that, but I've been recognized for that. Bankwest recently did the Broker of the Year awards, and I was Bankwest Broker of the Year for high quality submissions. So it's not about how much I write, it's the quality that goes in. So when they ran the metrics, I don't submit applications to get declined. We do that thorough research and make sure it all lines up. So normally on a strategy, you're looking at 2 to 3 applications to get to the result that you want. With those 2-3 applications, the first 2, you're probably looking at maybe refinance and getting a bit of equity, putting the right structure in. Second one, you might have another property. Well, how do we unlock some borrowing capacity, maybe unlock a bit of equity for a future purchase? So you want to be able to give clients options on how to set them up for the next 2-3 steps. But also while you've got the borrowing capacity, and a lot of the high level investors will tell you, if you've got the borrowing capacity now, do it. Borrow when you can borrow, because you don't know when you can have access to that money. So, like I was saying, one of my clients thought they could only do 1 property. and he'd inherited a property, but the property was under a trust, and he was the director of the trustee company. But he goes, well, how do I access that? No one's told me how to. Everyone seems to think that trust lending's really hard. And we just sat down and go, okay, well, what do you want to achieve? And he goes, I want to build a property portfolio. He'd already got his owner occupied, pretty much paid off, but he has an equity loan against it, and his first investment property in his name, which he built. And then he's got this other property unencumbered in his trust. So we walked him through that and, restructured the debt in his name. So now there's no debt against his owner occupied property. It's de-risked. We're all against the investment property, equity release against the trust. Had to revisit the trust deed because it was very, very old. Had to get some amendments on it. But again, work with him, work with the accountants, lawyers, whoever we needed to work with. And I've given him a roadmap for 2 more properties. And then he's going to rent his owner occupied out. And then him and his wife are going to go live where they want to live.
Yeah. Wow.
But it's a long-term strategy. So he'll have 4 investment properties in different structures, doing different things. They'll serve different purposes. It'll give them a bit of asset protection, reduce a bit of tax as well. And then they can just go live their lifestyle. Married, 1 child.
Yeah. No, that's great. And that's, congratulations, by the way, on that award. And it makes a lot of sense about, why I asked that question, because I know you're very much around the strategy rather than just throwing loans at people that doesn't build that long-term, stages in life or stages in their strategy. And that's the first thing we do as well. When a client signs up with us, it's sit down and have a long strategy and buying brief session. So we're all totally aligned.
Oh, 100%. And I think in this day and age, the clients that I sort of see already have dealt with a bank or a broker, and they serve the purpose. I go, yep. I say to clients, anyone can write you a loan. It's the strategy where the art form is, and how do you build on that? And if clients are always being with one bank, you're never going to be able to grow with just one bank, because they've only got one policy, pretty much one way to do things. And then you're limited in your product, you're limited in your policy, and you'll eventually be limited in your borrowing capacity.
Yeah, and that's something that most people don't know, actually. You just think, oh, well, I've been with Commonwealth Bank my whole life since their kiddie savings account, and I'm just going to be loyal to Commonwealth Bank. And you kind of say, well, if you really want to build a portfolio, you cannot be loyal to any one bank. We have to use a strategic broker who's going to help you, as very property savvy as well, to help you build that long term. And that could be across multiple banks, particularly if we go into self-managed super funds, as we do a lot of buying there, as you know, a whole different finance ball game there as well, right? In terms of who we can talk to, and the top 4 don't even work in that environment any longer. No,
they don't. And again, building out the strategy, to lay one more on top of that, which I didn't say for that other client. There is a talk there, we've penciled in a dotted line of SMSF, an eventual SMSF purchase as well. So you'll have 4 outside, 1 inside SMSF. You'll have 5 properties. They're all doing different things. Long-term, good strategy. But you're right. If you're paying, and I'll give you an example of paying the loyalty tax. The bank don't go and reprice your home loans every 6 or 12 months. You're going to have to get on the phone, be on hold for sometimes up to 2-3 hours, and maybe not even get anywhere. You may even actually have to put in a formal discharge request to get anything done so they can give you their retention pricing. If you think about your opportunity cost and how much you are worth to yourself per hour, is it worth you doing it? Or is it worth having a team like we do at Emerge who review your rates every 6 months to make sure that you're actually on the right rate? Even you may be on this rate, but the best rates may be 0.05 better. There's still no point in changing unless you've got a clear change in strategy. So that's the power. How do you grow it? You can't grow. And the strategy, was saying to elaborate, you can't grow without a strategy. And that strategy involves multiple people on your team. As I call it, you need to build your dream team.
Yeah.
Who looks after, it's a who, not how. Who looks after what part in your wealth creation, your legacy building? Julian, you played one of the biggest roles. Find the property that matches the strategy.
That's right. And I think that's where we have been successful in doing that and working with teams, as you said, accountant, financial planners and mortgage brokers, conveyancers as well as part of that team, buyer's agents, maybe real estate agents. So it's very much about building that team and taking that action as well once you've got that put together. They all play a different part and at different times as well. Mate, one thing we do have a lot of in our host of clients, and I guess even new clients that are coming on board, we have a lot of business owners. And a lot of them feel stuck sometimes on how to get finance. It's a little bit trickier getting finance for business people, as you know. Have you any tips or tactics on what's the best way for a business owner to get ready and to be finance ready? Because that's a really important thing, to be prepared to take that next step.
Business owners, I love you. Yeah, you can lend. You're just not speaking to the right people. That's what it comes down to. So as with any person wanting to get into the property market, regardless of whether you're self-employed, your PAYG, whatever you are, you need to be organized and you need to have a plan in place before signing contracts or anything. You need to get your team organized. You need to get what your strategy is and get that organized. Yes, it's probably going to take you time, but it'll cost you more by signing or buying the wrong property, setting up the wrong loan structures. We don't want that to happen. I think it's highlighted even more when you're self-employed.
Yeah.
Now, the reason why I say that is there's so many different variables to a self-employed person. So business owner, how long you've been trading, what industry you trade in, the history that you've had in that industry, how many sets of financials do you have, not only what your past look like, but what does your future look like? So I would say if you're self-employed, you probably need to be looking 6 to 12 months ahead, not the last minute. Now, the reason I say that is right now we're in quarter 4. Quarter 4 is where all your tax planning gets done. Now, if you want to lend money in the next financial year, you can't have financials that say, make it tax effective. I don't want to pay tax. Well, I'm sorry, if you're not paying tax, the money's being spent.
Yeah.
You can't say on paper you earn the money because the money's gone. So paying tax is okay because it means you're making money. It means I can lend you money easier. I've got more options for you. It's that consistency of income. That's the one of the other thing as well. So, we want to be planning ahead, being consistent in our income, having good BAS, keep being on top of your commitments. You know how PAYG clients, the commitments you have is paying your loan on time, paying your credit card on time, paying your rates, water, electricity on time. Well, when you're a self-employed, you've got that plus paying your income tax, paying your BAS, paying your super, make sure your bills are paid. If you've got car loans, they all need to be paid on time. We don't want to be in arrears. There's more to think about. So we want to be clean, as I like to call it, clean BAS, show the consistent income, have reduced debt maybe before we need to apply, even being strategic enough, using a broker who understands business structures, because they'll be strategic enough to put you with a bank that if you've got a lot of debt in your company, some banks don't look at the company debt. Right. That opens up more borrowing capacity for you. You need that experience to understand that. But a good broker should be able to flip between the two, PAYG and self-employed, because within self-employed, you can't actually be PAYG within your own company. And there are banks that have policies called a director salary, director wage, whatever you want to call it, because that's another strategy we could set clients up for. That 6 to 12 months is really important. Well, what can you pay yourself? We won't have to look at the financials if you do this or you do that. But the key thing is really working closely with the accountant.
Exactly. Yeah. And that's going back to that point about not being in isolation, where a lot of people just think in isolation and go to, like you said, their local savings bank and say, hey, I want to buy a property, and not really think about all the other permutations or the 10 points you just made then, which are crucial to doing that. And if you have a good year, we had a client recently who's had a very good year, and I was like, this is the time to take the money. the bank, you're going to look very attractive to the bank right now. If you've had a good year, good profit, this is the time to go to the bank. Go, I thought I might wait another year. The market might crash. I'm like, well, let me know when that's going to happen because I haven't seen it yet.
How's that going for you?
Yeah, exactly. So I said this, and so he did, and then obviously they were able to get some pretty good finance to get a couple of properties done in the year. So that's one thing. The other one we're seeing quite a bit of, and we've been helping a lot of our clients, working with strategic brokers like yourself and the accountants, obviously, is, a lot of what we're seeing, a lot of business people, especially when they get to that next, like you said, kids are done, private school fees, all that's done, and they've got that last maybe burst of their business to go, and they start thinking about, one day we'll sell the business, and that's our superannuation, that's our nest egg, that's the house by the water. But I've seen it happen so many times. Unfortunately, you don't get to sell that property, get to sell that business. The business changes, technology swallows your business up, whatever may happen, you get ill, that business is now worthless and you've got nothing behind you. So what we're seeing is working with a lot of our clients to build a portfolio, not just property, but a portfolio around that, and during good times in their businesses, taking some money out of the account and start investing using different structures, which obviously I can't give advice on. You can certainly help them loan that, but the accountant will set up the different structures and the different trusts to help them build a portfolio. So they're going to be in a very good position at retirement. And if they do sell the business, well, that's the icing on the cake.
Yeah, 100%. And what you just said just resonated quite strongly with me. Being a business owner, and I tell my clients to make the plan. What's your plan? What's your plan A, plan B, plan C, plan D? But you got to go out and also execute yourself. So I'm working with my accountant and a financial planner to come up with a plan to build my own legacy. That does involve property, but it also involves structuring. How do you, where does this money go? Can this entity be used for investment purposes, and how does that flow on 10, 15 years down the track? Now, I know people can't see 10, 15 years down the track, and we've got to trust the numbers, but when you're looking at very conservative numbers, it's great. But it's also, being self-employed, you can leverage actually a lot more than someone with a PAYG can do. And there was one more point I wanted to make with, talking about lending strategies for self-employed. There's two types of financials. I just sort of really touched on it. You can have financials for tax and financials for lending, but the way you do it, if you want to lend, you need to speak the language of the lender, not the ATO.
Yep.
And tax planning, we're in Q4. I'm actually getting involved with a lot of my clients' tax planning strategy where they want to buy next year, but they're like, what do I need to make it look like? Well, we all need to get into a round table and have a conversation with your accountant. Accountants love that. They're on board because they're proactive. And it means that, I need to probably take a little bit more vested interest in my client because they're building out. And, I've even had a couple of accountants go, can you help me? I'm like, yeah, sure. No worries. Let's have a chat. But, having the right structures, like you were saying, can actually maximize it, purchasing in trusts versus personal names. There's, again, get the advice. I'm not giving you the advice to do it, but that's a way to, reduce risks, so asset protection under a trust entity, but also protect your borrowing capacity to an extent as well. And on a high level, is not as tax effective. If tax is your goal, then maybe we look at purchasing in your personal name, or maybe it's not the next purchase in your personal name. Let's get one under here, and then we set you up to go to that. So again, it's a conversation you need to have with your accountant.
Yeah, no, really, really good tips. Really good tips. Mate, I wanted to dig a little. I've seen you grow. I've seen you really put your head down and, very motivated, seeing you go from an employee to a business person. And now you've started your own podcast and, you're a real go-getter, which obviously strikes me. And now learning about your previous career as a tennis coach at the highest level, obviously a very strong mindset. Obviously helped hundreds and hundreds and hundreds of investors, particularly if you focus on investors today. What are some of the traits that you see in those successful investors over your sort of journey?
Yeah, no worries. I've got a bit to that. I think there's two parts to that. So there are the lessons learned, and like you just touched upon it, the finance mindset. So you can do a lot of things yourself, but there's only so much you can get. So this is what the really good investors do. And we've already talked about it just previously in this podcast. Property is a team sport. This is what the good investors do. And it's not a big secret. Property is a team sport. You can't build wealth alone and in isolation. You can, it'll just be really hard. It's slower. I feel it's slower. The next thing, that team can't be a bunch of yes people. They've got to challenge your way of thinking and really push you to say, is this the best thing for you? But in the same breath, if they are telling you, yes, it's good, you need to take action before everything is perfectly aligned. You know, you were just talking about your client is, I might wait a year. Mate, yeah, you've got to be guided by the advice. Why are you paying people? Like, why do you have a team if you're not even going to listen to their advice? It's a waste of money. Just go do it yourself. So that's the key thing. That's the biggest thing I see. How do they get the team? So a lot of them don't come with a team. So someone like myself, I've got a really big network, which includes yourself. And that's, you got buyer's agents and they all do different things. I try to match people up to personality and what they're actually looking to do. Accountants, financial planners, solicitors, and the goal within having that team with the client in the middle is about cohesion and collaboration. You can't have one person saying one thing, the other person saying the other thing. It's conflicting. This is what the client wants. One saying no, one saying yes. You got to get in front of each other and go, oh, well, why is that? Be curious. Again, not a bunch of yes people. It's a bunch of, hey, we really want to help you. We want to help this client grow wealth. How do we do it? So it's that team and how do you get the team? That's sometimes quite hard to do. People don't know where to start. A good broker will already have a team, not only an internal team, but an external team.
So I guess it goes back that answer, that summary on that question, or that answer is really around building those team of experts around you and being able to take advice and take action, right? Is probably the other strong mindset that you've seen succeed.
Correct. And I think there's a couple of other things you probably, these are the real crux. So that's the top, those are really the top two. But you also got to make sure your finance strategy matches your tax, estate planning, and property plans. Again, that goes back to the cohesion and collaboration, because the top tier investors, they focus on cash flow and growth, as you probably know, not just one or the other. They look at it together and forecast. The other key thing is they review their lend. They don't sit on their hands and not do anything about their lending. They review their lending, their structures every year, not just when rates change or are going to change. They're proactive. Now, what does that actually look like? They don't go to the banks directly. They'll come to someone like me who looks after their finance, and my team will do that proactively for them, because the team does it every 6 months anyway for my clients.
Yeah.
They get an email, hey, this is where you're at. This is what they're doing. But they also, they look at the long-term strategy, and they build in buffers. They plan for peaks and troughs, because property is a long game. And you'll know that better than anyone else. It's a long game, and it all just needs to tie in. And you do need to be proactive rather than reactive.
Thanks, mate. That's a lot of wisdom, and I really appreciate you digging in deep there to help our listeners. But mate, we better wrap it up. Otherwise, you and I, we're good at talking for hours. But thank you for sharing all your insights and advice. There's so much there to unpack for our listeners. I will obviously put all your contact details in our show notes. What's a plug for your podcast?
Oh, sure. So my podcast is called Finance This, Property That. It's on all your major streaming networks. You can find me on Instagram at Dion Finance Specialist, and on LinkedIn, look me up, Dion Fernandes.
Thanks, mate. We'll put that in the show notes as well to make it easy for people to get in touch with you. But appreciate it. Thanks again. And I'll see you up in Brizzy in a couple of weeks.
Yep, no worries. Let's lock it in. Thank you so much, and I appreciate you having me on.
Pleasure, mate. You take care. See ya. If you enjoyed the show, it'd mean a lot if you could take a moment to rate and review it on your favourite podcast platform. It really helps us reach more listeners like you. And don't forget to hit subscribe so you never miss an episode. Thanks again, and I'll catch you next time.